All right, welcome back. I hope you're having an awesome time so far. Our next speaker is Aric Chang. He's the Executive Director, Real Estate Research at JP Morgan Asset Management. Please join me in welcoming Aric to our virtual stage.
Hello, my name is Aric Chang. I'm a research analyst for U.S. real estate at JP Morgan Asset Management. Happy to be here to share some insights on the current state of the office market. Our Real Estate Americas platform at JP Morgan manages $64 billion in direct real estate as a trusted advisor and fiduciary on behalf of hundreds of clients worldwide. Our real estate portfolio encompasses 160 million square feet of commercial GLA and 55 million of that in office alone. So we are actively engaged across multiple markets nationwide on a daily basis. We're obviously in the midst of a very deep and serious economic recession and public health crisis, but thankfully recovering quickly. From a pure intellectual standpoint, it is a very fascinating time to be analyzing real estate market trends, especially how quickly things deteriorated in last spring and how quickly it's recovering right now. So that means looking at market fundamentals in terms of weeks and months, as opposed to quarters and years like we used to, and also not overreacting to short-term changes, given how quickly things are moving. There is a wealth of new granular real-time data and analysis on leasing and mobility that we can look at today that simply didn't exist last time we had an office downturn. And I think that makes it a very exciting time to be a researcher. So today I will discuss what I think are persistent issues that the office market needs to address, some of the maybe perceived negative impacts on work from home that I do think are exaggerated, and also how we think about investing going forward. So with that, let's begin. Let's start with reviewing some current office fundamentals. And when I think about the current market, I do think it's important to look back at conditions as they were when we entered 2020, because it was very different than the run up to the GFC and dot-com bubble. For example, we had far less office development in the 2010s versus the prior two cycles. There are some markets that have more elevated construction activity than in the past, for example, like in New York. But by and large, the 2010s was a relatively muted development cycle. As the chart on the left shows, office completions peaked at just 1.4% of stock this cycle, which is far less than in the past. And then similarly, on the right-hand side, we can see that office rent growth was healthy in recent years, but it didn't have that extreme run-up the way it did in the late 90s and 2000s. So I think what that means is, tenant occupancy costs just didn't get way out of line. And as we'll discuss later, tenants really didn't heavily lease speculatively for future growth, as is sometimes the case in late cycle environments. So the office market, it's still recovering, but at least we're not contending with a lot of oversupply, and we don't have a problem with tenants' ability to pay rent. The market became much more optimistic in the fourth quarter and certainly in the first quarter of this year. Real Capital Analytics Commercial Property Price Index showing values on the rise again. That CPPI is an index that's based on repeat sales transactions. So it's not just based on appraisals, but even appraisal-based indices like NCREIF Odyssey, which is the benchmark for core real estate, is showing similar positive trends. On the right-hand side, where we do see the biggest disconnect in outlook is between the public and private markets. So the REIT total returns since 2019 for office are still negative on a cumulative basis. In fact, they actually underperformed retail. But our own internal appraisal-based indices, as well as our experience in transactions over the past year, are more in line with the chart on the left. I think a couple of reasons why the private market seems to be pretty healthy and optimistic, or at least more so than the public markets on offices. Reported rent collections, even in the worst of the downturn last year, they remained in the mid 90% range. Corporates are generally pretty healthy, and tenant defaults have really been low. And the majority of delinquencies that we have seen have been concentrated mostly in like retail and building bases, as opposed to the actual office-based tenants not able to pay rent. And as a result, we've seen office properties with strong corporate tenant credit, weighted average lease terms trade at pre-COVID pricing. All in all, still early in the recovery, but it seems like the worst is behind us. and at least growth on the valuation front. I think where the biggest concern is in leasing activity. And in short, there's just not a lot of it going on. As shown on the left, vacancy and availability spiked in the last year. Availability in aggregate across top US markets is near 20%. And what the near-term indicators are showing on the right is that the total square footage of leasing as a percentage of stock in the past year was less than during the GFC. And we actually haven't even seen leasing activity this low since the prolonged real estate recession of the early 90s. There are prop tech companies today like VTS. They're tracking real-time leasing activity and not just like absorption, but they're actually tracking touring activity. So that may actually be a leading indicator of executed leasing and absorption over the next 12 months. And VTS's touring activity index, which they call the VTS Office Demand Index, as of March was just 9% below the pre-pandemic level. So there might be some good news on the leasing front. Tenants looking at space is certainly a good sign, but admittedly still speculative in terms of how that might actually translate to absorption. And as such, there's still a healthy debate about what is the impact of work from home and how quickly does this office market recover. So I do want to spend a few minutes on this key issue of work from home. I think it's important to stress how we like to think about it is it's not just whether companies are going to work from home or not, what percentage, how many employees, et cetera, but ultimately, what is the actual impact that it's going to have on office demand? And I think that's where some analysis tends to be a little cursory, or if even too pessimistic. So first off, let's talk about office utilization rates right now. Obviously, they're still low. And we know this because companies like Castle, it's a provider of building access and security systems, have been tracking and publishing real-time data on building access and entry throughout the pandemic on an almost near real-time basis. They publish it weekly across major markets in the US. And this building access data has yet to break 30% across a basket of top markets. And although sentiment is improving as companies are signaling return to office plans, on the left you could see it's still extremely low, especially in the very dense urban markets like New York and San Francisco. San Francisco, of course, has a very remote capable tech economy. And that's also why you see a market like San Jose, Silicon Valley, it's the third lowest utilization, even though it's a largely suburban market. On the right-hand side is JLL Research's forecast for office utilization throughout the year. And so they project utilization back at 50% in the summer and then 80% by year end. Whether you think that year end forecast is maybe optimistic or not, 50% by summer is actually not that ambitious. If you look at many companies, they have already announced reentry plans, including big tech companies. A lot of them with stated goals of getting back to about 50% during the summer. And you see utilization rates are increasing on a weekly basis. And if you look back on the left again, you look at the markets where we have opened back up for more normal business activity, like the markets in Texas. They're at 40% already. And with some of the largest markets like New York and LA announcing back to normal plans for the immediate future, it's not unreasonable to see these utilization rates really accelerate quickly. So even if we have in-office occupancy recovering, there's still a question that gets asked, well, if we still had this lingering work from home, is that going to cause companies to shed space? And that's where I think a lot of times analysis is overly simplistic. They look at, say, 20% work from home, and therefore that's going to cause a 20% reduction in office demand. And I don't think it's that simple. And the reason is, for one, 20% work from home is not a new thing. So the impact of post-pandemic work schedules will really only be incremental if you consider how much densification has occurred, how much space optimization has occurred by companies, and also the fact that work from home is not that new of a concept. So let's start with the bottom left. That shows BLS data from 2019, and it shows that people were already in the office roughly 15% less on a Friday than on a Wednesday. And then if you look at turnstile entries from Grand Central Terminal in Midtown, for example, that shows a similar pattern of commutes in and out of the nation's largest office market. But and that's important because workplaces, they need to be sized for max utilization, right? Not just average utilization. It's just same idea as utilities need that generation capacity for a hot day in July, not just the average day across the year. Internet bandwidth needs to be sufficient for when most people are online. You take that all together and you find that actually remote work, that impact on leasing might be smaller than many think. Now, what about companies that have managed to be successful over the past year working remotely? And I think a key factor in that is, most workers, most or if all of their workforces might have been remote, right? And so there is that critical mass that helps. As firms begin moving employees back and staggering back to the office, even with the technological improvements, right? It's not a question of technology, but what they're finding that managing that hybrid workforce just has these like real practical difficulties there that are larger than they originally assumed. For example, the assumption that work from home means flexibility for workers. It may not necessarily be a reality, right? You want to shed space, and that might mean you have to force people onto staggered schedules, whether by day or by week. And so you may be able to work from home, but it's not necessarily a come as you go flexibility like many expected. And then also, just as in the past, there's that question both employees and companies have about productivity. There's always that perceived negative impact of being, the person on a screen as opposed to in a room of live interactions. So it is really ultimately that critical mass that matters, whether it's in person or in the office or at home. So the other thing, questions about the future of office demand, they tend to focus on how you slice the pie, right? You take the pie, it's either remote work or in-office work. And these concerns often overlook the fact that the pie is still growing. And we see that on the left. Office using jobs, in financial services and info tech and professional business services, they've grown faster than the overall employment. And that's been true over the last 5 decades as the economy has increasingly shifted toward a heavily service-based economy. And not only are American jobs increasingly based in office buildings, those jobs are increasingly productive. And you see that reflected in wage growth. So while the number of office using jobs has been rising, the share of jobs earned in those office using sectors has been rising even faster. And so that's important because tenant productivity is ultimately a reflection of the ability to pay rent, and that's a good thing for landlords. I will note, good office using job growth and wages hasn't necessarily translated to great space absorption, especially in the last decade. You see that on the right-hand side. After the GFC, especially in finance and legal, those are both industries that are big office users. They underperformed the overall economy. And then at the same time, you had companies of all sectors putting more and more workers into ever smaller spaces. And that densification resulted in weaker absorption relative to job growth in the 2010s, whereas the opposite was true in the 2000s. And I do think there is a limit to how much more companies can jam-pack people into smaller spaces, even with hybrid workforces. But we did see this record long economic expansion post GFC, and that means a lot of companies have seen their leases roll and optimize their spaces already over the last business cycle. And so I'm not expecting a massive reabsorption of space due to social distancing in the workplace. I'm actually kind of skeptical of that, but I do think there is this general sense in the industry that densification had gone too far, and there's even academic research that shows that it was actually hurting productivity. So I think the speed of densification going forward does slow, and that is a positive for the office market. And because of this prior densification, tenants were utilizing office space very efficiently in recent years. There's always this assumption that growth companies will just lease space speculatively to accommodate future plans, and especially tech companies do that. And then what happens as you hit a downturn is you have all this empty space that's unutilized, and it gets thrown on the sublease market. And that's what causes the spikes in sublease. But As you see on the left, what we actually see across the US right now is that the share of sublease space or share of available space today that is occupied is higher than it was in the past. And it's simply another way of reflecting what I was talking about with space optimization in the past. Now, by utilized space, I, of course, don't mean that workers are physically in their spaces. We know that's not necessarily true. But I mean that this is space that was built out, was furnished, and it was being utilized pre-pandemic as opposed to being physically vacant. And this is true even in, say, San Francisco, as we can see, with all its fast-growing companies. In fact, how tight that market got during the tech boom of the last decade, it actually became one of the most well-utilized office markets in the country, even with these companies growing so quickly. So what has happened is many tech companies, especially with workforces that are remote right now for the time being, they have put a lot of space that was previously utilized, but they put it on the market. I call it sort of opportunistically, just to see what happens. And they can feel like they can always pull it off the market, or if they lose that space, they can flex into additional space, on demand as needed in the future. So a little more on that flex topic later. But I think it does mean that I think a lot of that space does get pulled back as companies transition back to in-person work. And certainly these type of companies, continue to have a huge appetite for labor, and they certainly don't have a lack of revenue or capital growth, if you're following the equity markets. Now, we've reviewed fundamentals. We discussed, our view on work from home. Let's talk a little bit about, given the current state, how JP Morgan is thinking about office investing over the long term. And even though I do think there might be some lingering impact from work from home, I think it's exaggerated, but it's not to say that there won't be any impact. And then on top of that, there are real long-term trends, such as demographics, that need to be accounted for. So we are shifting how we think about office compared to how we invested in the past. When it comes to developing any sort of investment strategy, I often like to think that you need to acknowledge the headwinds and then also think about the growth going forward. So what are the headwinds, right? Densification, we talked a lot about, and that is real. I don't think it reverses itself because of social distancing. That's probably a little too optimistic. But remember that densification did not stop the markets that had this great economic dynamism from outperforming. And what I mean by that is look at the left-hand chart. That's the share of total wages from traditional office sectors, such as, say, law, finance, and accounting. It was pretty flat across the last two cycles. And then you look at the share of wages from high tech and information related sectors, the new economy. And those tenants tend to be the most dense users. They have open seating, very dense build outs. And you can see that on the right hand side. Densification occurred more greatly in San Francisco, which of course is a more new economy market than New York. But at the same time, rent growth, occupancy was fairly stagnant in New York over the last 15 years, where San Francisco was undoubtedly one of the best office markets over the last cycle. So, that's because new economy companies, they might be the densest users, but they still create good office markets. They create these innovation clusters that attract talent, that grow companies, spin off other companies, and that's just generally a net positive for the office market. So the thing that we like to think about is what are growth companies doing? How are they using office? Where, what, and how are they leasing? So as to where, let's look eastward and southern. Follow the expansion of the large market cap tech companies like Apple, Microsoft, Google, Amazon, Facebook. Just like people, they're all moving to sunny, pro-growth, pro-business states. And as a result, Sunbelt and secondary markets are nearing a return to pre-COVID leasing volumes much faster than gateway markets. I will say we have to be cognizant of some of these type of markets. Even though they might be fast growing, there are often places that have low barriers to entry for office construction. In addition, there are often markets that have a large single tenant or build to suit exposure. And so that means we might be more apt to build new in a merchant build strategy than buy existing in these type of places. And while office development might traditionally be viewed as more risky, you do have to weigh, that risk of merchant build strategy versus the very high depreciation risk that comes in these type of markets. On the what, and that refers to what physical assets are drawing the most tenant demand. That desire for, densification, as well as, all industries just mimicking the type of workplace design that tech and creative companies developed, they disproportionately shifted absorption in recent years toward, the newest office buildings. And I think this bias toward just the most modernized space should continue, as the environments that allow for the type of efficient floor plates to put as many people as possible. Maybe that's not what people are going to look to do going forward, but they're also the same environments that provide, the most light and air, elevator, bathroom, hallway capacity, and those are going to be the things that are most desired. And they're still coming out of you need new office, most efficient office to do that. And tenants are just especially image conscious, especially with large corporate headquarters. And this notion of you need the best space in order to attract workers and to retain them is something we just constantly hear. So it's not about rents, it's not about occupancy costs, it's not even about location. And that's important because I think, a lot of legacy trophy locations can possibly be a value trap actually going forward, because, workers may be less concerned about, commutes. They may care less about public transit if they're spending some of their time working from home. But what they want is when they do go into that office, that space is going to be very functional and quite frankly, very, very good for their well-being. And then on the how are companies leasing, especially the growth companies? And the co-working trend that may have died quickly with the collapse of WeWork, and then the pandemic steering people away from this notion of shared communal spaces. But the trend towards shorter and more flexible leasing certainly did not go away. And some of that decline in average lease term that you see on the right is possibly a result of tenants just taking, very short-term extensions given just the general economic uncertainty. But I think a lot of it is also companies actively trying to manage for variable space needs. And they're doing that through a mix of both short and long-term leasing. Traditional long-term lease structures, they risk both the tenant and landlord stranding a lot of, capital in the form of expensive and wasteful TIs and build outs. And for owners, these big long-term leases, often they seem like a great idea at first when you're signing them in the near term, but they do create longer term, these binary risk in liquidity and value when those leases roll. And then, so if you're getting lower capital costs, leasing costs, potential higher stabilized occupancy, less lumpy liquidity and valuations, those are all positives for owners. The thing for owners to keep in mind is to be mindful of the fact that when you're underwriting, that your business plans, maybe not more capital intensive, but they're certainly going to be more leasing and tenant management intensive. And so that's a quick, where, what, and how we view office investing in the future. And I'll end with this. There's no doubt the pandemic recession is hurting office along with some other property types right now. But we do see these long-term changes as more evolutionary as opposed to revolutionary. And we still think that investing in office, which serves the most productive workers for top growth companies in the nation's most dynamic places, is a viable and large investment opportunity for real estate investors. But the preferred office assets for the long term, they may differ from those that were successful in the past. So, office investing will very much become more about asset selection as opposed to beta. And so with that, thank you again for listening. And I thank RETCON for inviting me to share my perspectives on the office market with you all.
Awesome. Thank you so much, Aric. If we could just stop the screen share, I know the audience wants to give a huge virtual round of applause. Awesome. We thank you for sharing these thoughts with us. I know the audience has really enjoyed it, and we really appreciate your insights. For the audience, it's time for you to make your way to your next session. Along the way, make sure you accept your connection request and check out our amazing exhibits. Thanks so much, and we'll see you around.